Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
What's up, everybody? Anthony Crudele here, and thank you for tuning in for this episode with Ira Harris. Futures Radio Show is sponsored by CME Group. They are the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. Remember, new shows are posted on Mondays and Thursdays. You can subscribe to the show on iTunes, YouTube, Google Podcasts, Spotify, and Stitcher. If you're enjoying the show, please leave a review on iTunes. This show is also sponsored by Trading Technologies, FTSE Russell, and RJO Futures. To learn about some great offers that these sponsors have for our listeners, please visit futuresradioshow.com/sponsors. Today I spoke with CME Group Board of Directors, futures trader, author of my favorite blog, Notes from Underground, and my good friend, Ira Harris. Today, Ira and I kicked off the conversation, doing it a little bit different than we have in the past, by asking him what markets he was currently trading. And then from there, I asked him to explain why he's trading those specific markets right now. Let's face it, we're in a time where there is so much going on in so many different markets. And with a great trader like Ira, I wanted to know why he's choosing to trade these specific markets. Out of the gates, he talked about the U.S. dollar and foreign currency. So we talked about that and why Ira is stressing that the U.S. dollar is a primary focus of his right now. He explains why he's so bullish gold, how he's trading treasuries and yield curves, oats, yeah, that's right, the oat market, and wheat. And last but not least, we talked a little bit about crude oil, Russia, and Putin. So without further ado, let me take you right to the interview with Ira. Ira, welcome back to the show.
Thanks, Anthony. It's been a while since we've talked, but the world has certainly unfolded in some very interesting and I'm sure some people would say diabolical ways. So, but a lot of what we've talked about has come to fruition only because you and I have discussed this debt issue and how the systematic overload of debt is what was going to be a problem for this. And it only got revealed through, of course, the impact of what I would call the demand shock. Others will argue a supply shock, but I argue demand shock from the COVID-19.
No doubt about it. And that's definitely a topic I want to discuss today. And you and I have done so many interviews over the years, and I want to change things up a little bit. And the way I want to kick off today's show is I want to ask you simply just what markets are you trading right now?
Anthony, I'm really not trading many S&Ps or equity markets. I may trade some of the foreign ones. I'm trading a lot of foreign currency because I have certain views about what's going on, and I think I've been dead right on target, maybe not as far as market movements, but what the central bank response is going to be. I was trading a lot of the debt market, treasury markets, and foreign bonds, but I've stepped back here because I'm trying to understand what the impact is going to be from all the Fed action and what the Treasury is doing. So I want to see the way markets are sizing up, but I actually caught the first leg of this steepener because that was one of my favorite trades, and that did happen, but now it stopped happening, and I was smart enough on a Sunday night to say, you know what, things are a little different here. It was 2 Sundays ago, and I said, I'm getting out of all my steepeners because there's things that are happening, and when I don't understand them, I step back. Trading a lot of metals because metals have been a very important element for my whole dynamic of understanding central banks and the discussion I've had about that metals are not a hedge against inflation initially. They're a hedge against central bank credibility and their ability to act. And it was more based on the fears of deflation, which this is what we're in the throes of right now. And I'm trading a lot of commodities, believe it or not, both ways. Some based on foreign currency movements, and others based on I think that there's coming shortages. And I've actually this past week, and I know the seasonals are in favor of it, but I'm watching the oat and wheat market very closely because there's certainly a dynamic at work in the global system about certain shortage or feared shortages. So I'm really trading everything. Not really trading that many equity markets because it's not where I I'm watching them, but it's a high speed, high frequency trade for me unless I get to some key levels. Then of course I'll trade them, but otherwise no. Much more focused currency metals. Interest rates I'm very attuned to, not trading that much and trading a lot of commodities.
Okay, so the reason why I wanted to start off with that question is because typically you and I will talk about the global macro themes, the situations that you're seeing, and then we take it back to the markets you're trading and then the technicals. So I want to do it reverse this time. And so I just jotted down the markets that you're trading. You talked about trading a lot of foreign currencies. You're trading some treasuries. I know that you talked about one of the steepener trades, precious metals, I'm assuming gold and silver. I know you like to trade those markets, and we'll talk about that. And then you said commodities, oat, and wheat markets. So let's start off with the foreign currency markets. Why are those the markets that you're trading right now? So give us the global macro situation as to why you're looking at those markets, and then talk to us about how you are using the charts, the technical analysis to guide you through some of those trades.
Okay. So the currencies are very interesting to me and have been because as we saw, and actually I blogged about 6 weeks ago calling for the Fed to cut 50 basis points right away. And because you could see what was going on, how the markets had shifted. The first 2 weeks of the year, and we had talked about this, that it looked like we were going to see some up moves in commodity markets. Oil was moving. A lot of things were moving up. The dollar was actually weakening, and the emerging markets were starting to strengthen. Both equity markets and their currencies were performing pretty well. And we did a volte face quickly once the impact of the virus really became to be known and everything reversed. And when it reversed, you saw the dollar start to strengthen, and yet it was wreaking havoc. It's still wreaking havoc, especially in the emerging markets, because they have so much dollar-denominated debt. So when the dollar goes up against their currency, the cost of carrying that debt, which was cheap, which is why they took it on, becomes much more expensive. And coupled with the dramatic fall in commodity prices from copper to oil, grains, sugar was up at $15, is now down at $10.50. So these affect the emerging markets, quite a bit. And my thought was that the Fed had to get more aggressive because they had to find ways to weaken the dollar. This strong dollar is undermining a lot of the work that they're trying to do on a global basis. And let there be no question about it, that the Fed has to be as much concerned about the global system as they are about the domestic system. And that's been my point. I said they have 3 mandates. And it's interesting because in 2019, we had a couple speeches and a few papers written by Richard Clarida, the vice chair of the Fed, discussing the international role that the Fed plays, and because of the dollar. So this is why I'm really been involved watching this.
So it sounds to me as though the dollar has become your central focus right now, a primary focus of yours, I should say. And what's happening in this global macro situation and its impacts on the dollar are giving you reasons to step in and trade foreign currencies.
Yeah, that's 100% right. That's 100% right. Because it reflects that the Fed policy up to this point has been really a failure because they cannot get the dollar down. They need a lower dollar. The world needs a lower dollar. And I can walk you through because that's going to be today. I'm going to blog after I get done with you and I'm going to talk more about this. I've been talking a lot about it, especially with the Europeans. They need a weaker dollar because so much funding is done in dollars, and the world does not just need, this is not a trade issue. This is a financial system issue, and there's a big difference in that. So when I say that the Fed needs to, I've been calling for the Fed to intervene directly, almost like a pause accord, but to do it on their own because the world demands that they do it on their own. You don't need an agreement. Everybody gets caught up in these old rules because this is not a trade issue. They're not directing it against Japan. They're not directing it against China because they're not directing it against Germany. This is an issue that the world is crying for dollars in order to fund all the debt that's out there. They need a lower dollar. End of story. And the Fed knows it too, but they're failing at doing it. So it'll take a direct sense that the Fed will intervene in the dollar market any time to at least get the ball rolling for a lower dollar.
So something that you and we've talked about a lot, even going back to when we've talked about, how floor traders would trade. And one of the things that I learned on the floor was when you see somebody that's stuck, right? A guy who's just in way over his head in a position and they start to unwind them, they have to do something. And that could go from a local to even a broker to where you're just seeing they just have to do something. What I'm curious about with you focusing on the dollar, is that because you think that what's happening now has caught a lot of people off guard? So is maybe part of your edge is that they have to do some of these things? So it's forcing these moves to be bigger and stronger, and so you're able to capture them?
Well, they really haven't started yet. The dollar is stronger. The dollar started to weaken about the previous week, but this week the dollar strengthened all week, which showed me that, again, the Fed is, and they have to be scratching their heads. And sometimes for the last 3-4 weeks, we get stuff done on Sunday evening. It's like 2 weeks ago when the dollar did start to weaken, the Fed had announced what I had actually been calling for 2 weeks prior to that, opening swap lines, not just to developed economies, but to the emerging market central banks so that they could swap their currencies for dollars. And they did it. But it's still not enough. There's so much. What I think from the International Institute of Finance, that the last numbers when this started was that there was $11.5 trillion of debt in the emerging market world, and not just sovereign. We're talking about corporate debt because everybody, again, was borrowing in dollars. It was a cheap borrow. It's almost, retraces what happened in Switzerland in January 15th, 2015. There's, when people were, again, they had borrowed in Swiss francs. So when the Swiss pulled the plug on the peg, the move was very dynamic because all these people were caught wrong-footed. It's not quite as bad in the U.S., but it is a sustained, because if you had told me that the Fed, doing all that they're doing and the dollar is still rallying, well, you have a systemic problem, my friend. And yes, I know part of it is because of Europe, and we'll get to that. Europe is again trying to figure out what they're going to do or not do, and it is causing again the dollar in the short term to be the cleanest shirt, as they say, in a basket of dirty clothes, but they're all still dirty. So the Fed has to do more. So I'm just looking for this. When? Can't tell you. But it better be soon because it bothers the Fed, and I know that because they've done the swap lines, they've done what they think everything they can to minimize the upward movement in the dollar, and yet the dollar still sustains itself. But they don't need to stop the upward; they need to start pushing it down, and let the market start really working to take the dollar down. But we haven't seen it yet. But I'm very attentive to it.
I understand the global macro reasons as to why you are focusing on the dollar and foreign currencies. Let's take it to the charts.
Okay.
What specific currencies are you trading? And just walk us through some of the things that you're looking at on the charts to help you get in and out of some of these trades.
Well, believe it or not, we won't. You don't want to know the emerging market currencies I've been trading, because I've been trading them when I think I see an inkling of something, so I'll move. But again, it's a trade. I'm not putting on positions of any the only position I've been running is a metals position, but I'm not putting on because again, I'm not getting the picture that I need to get. But my fundamental analysis, which I believe is correct, will eventually take hold. It's just not yet. So everything's still a trade. Like on Thursday, Friday, I actually was long ruble, which is a very liquid market, by the way, on the CME. Not at night, it's not so liquid, but during the day, very liquid. So I actually had a long ruble position that worked out very well. I've caught bits and pieces of the peso at times, but you have to discern when they break away from certain correlations that people have built over the last few years. So, and we're starting to see those correlations. But at times I get along the euro thinking, well, they're going to, because I'm watching the European bond markets, and that will give me a little hint at times. So I'll get along some euro, but I've been out of that because, again, they're dragging their feet, and I've actually used it as a short against the gold a little bit here over the last 5-6 days. The yen, at times, people rush to it as, again, they think it's a haven, but it's a false sense of a haven. The reason that the yen plays the role of a haven is because the Japanese have so much money invested all over the world, and when they bring it home, it moves the market fairly dramatically. Plus, March 31st is year end for the Japan financial system. So there was the yen really strengthened into it because people have to bring money home to balance and shore up their books. But so now I'm watching the yen, and the yen, again, because this is not a trade issue, this is a financial issue. The yen, this is not going to be like the Plaza Accord where you're targeting the yen. So that will be of the major currencies, ought to be the weakest. So I'm running, and I don't have any really good location yet. And I have to stress it. I trade really strongly when I have good location. A couple weeks ago, when the euro did rally, I had very good trade location in support at 106.30 to 40. You can see it on your chart if you put up the euro, and that proved very well. We got a 6-cent move up pretty quickly, and that's when the Fed opened up the swap lines, and that's the week when the dollar really performed weak, but it's traced back. And I'm using the Swiss because the Swiss really is my anchor to be long at times. So if I want to be short the yen, I'll put on Swiss yen, which is a very interesting chart too, because it held the two. It's hanging around at the 200-day and the 200-week moving averages. So I do get some location there that can give me some trade possibilities. So that's really what I'm looking at. I've stayed away from the sterling because the politics have just been a little mixed. Although the sterling did have a nice rally against the euro sterling is very interesting in many ways. You don't hear anybody complaining that right now that the Brits aren't in Europe, that they're not involved in some of the more heated discussions going on, which is a good thing. So that euro sterling cross, I know, which over the summer we looked at it quite a bit. We ran some really nice charts when we did the television. So everything's been dynamic moves because everybody's trying to figure out how this, not how it begins, because we know how it begins, but how it ends and where you're going to get the most value. So, I'm just dancing around in that, looking for some, when I see some locations that'll tell me that there's bigger moves afoot, because the dollar needs to go down, and the Europeans need to get themselves together here because they're going to have to make some major decisions. And if the Europeans made certain decisions, I think you would start to see the dollar head down.
Hey, everybody, a quick pause here to talk about FTSE Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small-cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 Index Futures Contract, symbol RTY. For more information on FTSE Russell and their products, please visit FTSERussell.com. Okay, I just want to spend just maybe another minute or two just on the dollar and these foreign currencies. I'm trying to picture in my mind. So I actually have up my charts in front of me. And as you've been talking about markets, I've been pulling up charts. Just give us an idea of what you're looking at. I understand that the central focus is the dollar. So the dollar, you look at the last, 3-4 days, it started to come back up. Now the dollar is going up on those days. What is it that you're looking for in those other currencies now that you're seeing the dollar going up? Because you think that the dollar should be going down. So in the days that the dollar is going up, what is it that you are looking at and how you are planning on trading those currencies you talked about?
Well, I'll be looking at the cross rates because, again, when I see certain levels that don't hold in the euro and I'm looking at the politics and the discussion going on, then I'll use the euro as a short, especially against the gold. But we haven't even gotten to that discussion. But that's been one of my favorite trades, the gold currencies, for the last 2 years, 2.5 years. So I'm looking at that. So I look at the euro and I go, well, it didn't hold here. This is not a major level. And again, as I come back to the 106.30 to 50 area, that gets interesting, and it should hold there again. Here, but here's like a classic day. Okay, let's take Friday. Friday, the euro was, under pressure all day, and then in the last hour, it came back. In the last 2 hours, it came back. So even though it closed weak, it was not nearly as weak as it was all day. And the yen kind of was different than that. The yen was strong most of the morning, and then towards the later part of the day, that gave up a good part of its relative strength, and even though it really was not great. So I'm watching those relationships because a lot of those are also still tied to the equity markets, because again, they view the yen as a haven. So when the S&Ps are getting hammered, they start buying yen. I think I think that correlation to me in the big fundamental picture is broken down, but you have short time, algorithms that are still pushing it during the day, which, okay, you know what? We trade the flows. We trade money flows. And when the money flows are, still tied to that, you have to respect it. So, then I see where the oil is, because the oil will tie in to certain emerging market currencies. So I'm just watching all of those all day long, which is, you can only do it. I don't have it automated. It's just me on a discretionary basis. And, I go out and take a run. I go out and take a long walk. You got to get out from under it because it's just so crazy, as and you move it. And you're going to see movement. But if you think you missed something, forget about it. It's like trading the S&Ps now. You're going to see 5 major up and downs during the day now for sure. So you got to get away from it and say, okay, I'm seeing this, and think about it. But that's the correlations that I'm looking at. But I know the big picture. And I say I know because the Fed tells you so, that they want a weaker dollar. If you don't think that a lot of what they're doing is to weaken the dollar, I think you're badly mistaken. But it just does reflect the movement in the markets. So that's what I'm doing. So I have a panoramic view of it all. As you know, I have all these variables up on my screen, and I'm watching it, the full panoramic view, and looking for those places.
Understood. Yeah, just so to quickly summarize it, because I want to move on to some other markets and some other topics here. It sounds to me as though, because the dollar is so important right now, and you have an idea from what you are seeing with the Fed that that they want a lower dollar. So you're watching these foreign currencies and kind of this web that all comes from the dollar, and you're watching to see what markets are having these sensitive moves, that are having these reactions to what you're seeing happening in the dollar. And if they're breaking down technically or working technically, either way, right, that you're looking at those as your trade opportunities.
Yeah, you said it better than I did. Right. It's the sensitivity to the different variables. That's what we're looking at.
Yeah, exactly. No, I understand. All right. I want to move on, and I want to let's talk about gold, because let's face it, you and I don't think we've ever had a show, Ira, where you and I have not talked about gold. And I think the last time we talked, it was about the possibilities of us going to war with Iran, that was pretty short-lived, as we kind of thought, and we talked about on here. And you always said, and for years you've been saying this, don't buy gold in anticipation of a war. Right. And we talked about that, but now things have changed so much, obviously, since then. And give us a little sense of what you've been trading these days with gold and just in the precious metal space in general.
Okay. So when this began to start, it was the beginning, meaning when all the central bank action began to really take place. And you can go back and read my blogs, and the start date is February 2nd. That's when because I was daughter for a couple weeks, but I really started this and getting involved in this discussion and calling. Right away I called for a 50 basis point cut. For the reason was, of course, the weakened dollar, but I expected the gold to really take off right away, because this was exactly what I have discussed when we did the show with Santelli in 2016, and well before that. I've been blogging about this for even in 2009 and 10. Gold is not an inflation hedge in the classic sense. Gold is a hedge against central banks losing their credibility and losing control of the fiat currency world. That's what it is in my mind. And the greater fear was deflation, as I've always maintained, because central banks will bend over and break themselves to prevent deflation from taking hold. So if you think if that is what their end game is, then gold becomes the most qualitative hedge against that. So I expected gold to really take off, as you know, because you brought up the point when the United States assassinated Solomon, and people I said no, and gold did. It had about a 2-hour rally, and then it was over. So it proved my point ever again that geopolitical events don't. But this is not a geopolitical event. This is, of course, exactly what we have discussed, with central banks not really knowing what to do, and again, just doing everything that they possibly can. And I'm not making a statement about whether they're right or wrong. I'm not making that. There's no judgment call on that. It's just what they're doing, because they are trying to prevent a deflationary spiral from taking hold in the world. Because with all the debt that exists, nothing is worse than a deflationary spiral. If you don't understand anything I tell you today, understand that a deflationary spiral is anathema and dangerous to a system laden with debt. Take that away and think about it, and you'll understand the message, what I'm trying to teach you, and how you have to react to it. But as usual, I failed to understand, and I got hurt the first leg of this, because the amount of liquidation of assets was overwhelming any sense of fundamentals. You know, that as Dennis Gartman has so famously said for so long, when the whorehouse gets raided, even the piano player gets arrested. So people who needed to raise cash were liquidating everything. So I would step into the gold market while the gold was even cascading lower. It went all the way down to 1452 from being over 1600, and I kept stepping in a little early because I had support levels. And then when it was ready to do its turnaround, as people started to realize, hey, where am I going to go hide out? Where am I going to go hide out? The dollar is not a haven. Yeah, I know, the U.S. system. But when the central bank is doing everything it can to prevent the deflationary trap from being laid, that's not it. They're printing all of that, so why should I be buying that? So I started, buying gold, and that which didn't work then became dynamically dynamically in my favor. The missing element, and we'll get into that, is silver, because we saw the gold-silver ratio go up to, I think, 122, when the previous historic high was like 98 ounces of silver to an ounce of gold. We got up to 122, 123. So you see that the world is in the throes of that gold is always it's the one precious metal that's always deemed a hedge. And because I think you've had so many central banks loading up their gold reserves, that puts even more upward pressure. And silver is deemed to have a dual character, which is, of course, it has an industrial base, which is why it outperforms gold when the economies are humming pretty well. And it has a precious metal base, but just not as considered as much on the global scene. So that's been my views. And, the gold struggles here, we still have not made all-time highs, of course, and it's still, but it did close out pretty well for the week, although basically unchanged. So let's talk about last week. With all of this monetization going on in the system, gold still basically only closed unchanged. But there's concerns afoot in the market about whether there's even enough deliverable gold that exists to meet, the positions and paper gold. So the market has a lot to chew on here. But I still think gold is going substantially higher as people realize what has taken place here. And that's even with, and God willing, as I would say, we come to some type of scientific basis to turning from the drastic effects of this virus. And I don't mean just the deaths, but of course the economic impact. But gold will become even more important because do you think the central banks are going to reverse as fast as they jumped into action? Not a chance in this world. Because now they're saddled with this program for quite a while regardless, because they'll be fearful about reversing too quickly. So that's my longer-term view on gold. And again, you have to look at who owns the gold. And I actually have in front of me the list of the 20 largest holders of gold by country. United States has the most. Austria is at the bottom of the 20, but interestingly enough, the IMF is basically in third place, following Germany. Germany has the second most. So there are other countries, and China and Russia have been building up their gold reserves because they see this. They have a lot of dollar exposure. And if I was China, as I wrote that one blog, that China offered to swap all their treasury bills for Fort Knox was tongue-in-cheek, but maybe it's not so tongue-in-cheek because everybody's carrying a lot of exposure to U.S. dollar assets, and yet we know what the Fed is doing here. And what the fiscal authorities, meaning Congress, is doing. So how long do you really want to hold on to dollars? It will be the question. And the Fed would actually like that. So,
listening to you, it sounds to me as though gold is just bullish right now. There's nothing in the short term that you see, or even in the medium to potentially even long term, that would get you away from buying dips in gold.
Yeah, right. But again, always location with me, because I'm not just throwing darts against it. No, yes. I have to find good location, and I like corrections because I'm still trading it. You can't sit there. This market has told you everything is only a trade right now. I'm thinking more long term as to where, meaning I'm thinking out a year and a half. How, because I always look at end games. How do you, meaning an exit strategy, and tell me what the exit strategy is, and I'll have and then I can have a much better handle on the end game. So that's what I'm looking at. They're doing a lot. They're throwing all caution to the wind. As I say, there are no rules. The Fed is bending as many rules as possible under. I'm going to get wonky, but Article 13, Section 3 of the Federal Reserve Act. You can read it, and they're buying corporate debt, and they'll eventually basically do as Draghi famously said, whatever it takes. Well, that's kind of the hat that they're putting on, whatever it takes. And of course, you have Congress that just passed a $2 trillion stimulus or more, and they're already talking about the next one. So, you know what? There is nothing going on but what in their mind is salvaging the system. And make no mistake about it, that's the language. They're salvaging the system. They're preventing a deflationary spiral which will devastate the system because of all the debt that exists. There's nothing more than they would love than 6, 7, 8, 9, 10% inflation right now. Everybody talks about it. There's nothing more because that would minimize and lessen the impact of debt. Nothing wipes out debt better than inflation, by the way, because if my prices go up, my debt costs don't go up. If I have a 10-year loan, locked in at 3%, but all of a sudden prices start to rise, I'm paying you back with cheaper dollars. The emphasis on cheaper dollars, the Fed wants a cheaper dollar to help stabilize the global system. Can't get away from it.
A question I constantly get is, what platform do I use to trade futures? Well, I use TT. They are the world's fastest commercially available futures trading platform. Now they have integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. You could try it now for free at tryttnow.com. I just want to go back to when I said that even in the short term or even the long term, that you'd be buying dips in gold. I'm glad that you put some context to it because, as everyone knows that has listened to me and you in the past, we always talk about knowing the macro theme is only one part of it. The charts have to align with that macro theme, and it helps us guide our trades and manage risk. So I'm glad that you mentioned that because I just want to clarify really what I was saying was that if you see something on the technicals for a good period of time going forward that's bullish gold and it's a long setup, that's a green light for you to get long gold.
Listen, that's why February was not an easy month for me. I had a really good January, but February, because we had a lot of those, again, you were getting liquidation moves. And those have always been problematic for me because the fundamentals don't change, but the dynamic of liquidation is always more powerful than I believed. And that's been throughout my history. So yeah. I always think I'm learning and I'm more patient. As you and I talked about my wish orders. Well, I leave orders now. I mean, you see $25 moves in the gold prompted by nothing. I go out for a run. I go out for a long walk. I come back. All of a sudden, I'm filled, and the market is back to where it was because these things are going on all day. You are seeing all the volatility you could ever dream of, and really from my perspective, and I would say probably yours, Anthony, a lot of the quants have been so badly shaken. They're not in there doing what they were doing. I have done several shows with you warning against these short vol strategies that you were playing with death. And you know what? They've played with death and a lot of them are gone. So it's for a fundamental based trader who then uses the technicals to determine my risk points and my exit strategies. This is now the market returning to my basics. So you know what? I don't wish it. I'm not a Schadenfreude person. I don't wish bad to people, but if the market clears itself of some of these strategies that have really wreaked havoc with the fundamental analysis for several years, I'm not crying for them.
I want to move on. We've got two more topics that I want to go over before I let you go. And thank you for joining me on a Sunday, by the way. I want to talk about Treasuries. At the beginning of the year, when you and I spoke about the macro themes for 2020, that was a very important call for me because every year at the beginning of the year, I always want to hear what you think is going to be a theme for the year. And you said lower for longer. That was a theme. All right. Obviously, without question, that's happening as we speak right now. How have you been trading that?
Right. You know what? I was trading quite a bit of treasuries, but I think it was 2 weeks ago on a Sunday when I read what the Fed had done. I said, well, and when they announced how many more treasuries they were going to buy, I figured, no, this ain't. And even Lael Brainerd and a few others had talked about yield curve control. That's when you see that YCC, yield curve control, which Japan has done. Which is a way to reinstitute what they did back in the late 40s and early 50s until they reached an accord with the Treasury, until the Fed did. So when I saw yield curve control, because I was playing steepeners, and I was actually doing quite well with the 2.5s and the 2.10s, and every once in a while I'm putting on short 30s against it. But then I said, you know what? This is going to be a losing proposition until I figure out what it is that the bank's going to do. So I've really been out of the Treasury market for 2 weeks, and I'm just watching it because I learned a lot in trading the European sovereign debt markets. Since Draghi, probably 2014, 2015, because the bank, they were buying $80 billion a month. So I would watch it, and I would try to get some levels where I would trade, because I would say, well, the bank has to come in here. The bank has to. So now, from learning that, now I'm stepping back and watching what the Fed is doing here. Even though the Fed tells the dealers in the market when they're going to come in on a daily basis, it's posted. But the impact of this Fed with the massive amounts of buying and the massive issuance of T-bills that is going on, because the Treasury is trying to keep everything short term for the while they're issuing to fund this massive spending programs, T-bills. So I'm just taking a step back. This is a learning time for me, and I want to see how things are coordinating, and I don't want to step into it. So I've been out. I did really well in March, at the beginning of March, with the yield curves, because they did exactly what they should have, steepened out dramatically as the markets got nervous that the Fed was just going to be, again, with all this creation of liquidity, that you wanted to shorten your duration. So people were buying the front end and selling the longer end. I mean, you saw it across board, even the euro dollars curves, because I was trading the DEES 2021, DEES 20, DEES 21, which is a short-term curve, but that went from DEES 21 being almost 20 points positive to DEES 20 down to negative 10 as a sign of how much steepening was taking place. That's how dynamic that was. And now we're back to the 21 is 5 points premium again. I think that's where it closed at on Friday. So there are movements afoot. I'm really not trading them. I want to watch. Now, my scenario still stands. Anybody who buys anything more than a 2-year as an investment, not as a trade, if you put it, your trading head is different, but if you're buying it as an investment at this time, and I know people have to, I certainly don't respect you as a financial analyst, because the Fed's telling you what they're going to do and what they're going to try to do. So outside of the Fed buying the long end, I don't know why anybody would be buying the long end. I know that people need some duration strategies, but at these kind of levels, to me, I don't see a way you can possibly ever make money, ever. And yet and if the Fed is victorious, you're going to lose a lot of money. So I stay away from the long end, except as a trade. I'll trade it, of course, during the day once I get my opinion about something, but not as an investment. So that hovers over me, and I'll be looking to do some dynamic steepeners. It's just too early for me. I have to really see the way this Fed action starts to play out.
I, too, have stepped away from trading treasuries. I mean, at the beginning of this year, when you talked about lower for longer, my mindset was, okay, Ira is saying the global macro situation is you want to be buying dips in treasuries. I was looking at that. I think since the coronavirus, the 10-year is what I focus on, 10-year ultras. Very difficult trade now. I mean, I'm not trading it the same reasons that you are. And as an outright trader, like myself and many of the other listeners out there, what are your thoughts on just like, what do you see happening? And let's just say the 10-year, 5, 10, and 30-year going forward right now.
You know what? They're being supported, of course, by the Fed action. Interestingly, while the Fed is busy buying this, foreign central banks, I think in March, liquidated 109 billion of treasuries. Well, and you know what? If I ran a foreign central bank, I'd be doing the same thing, because why would I sustain and hold an asset that they're telling me that they're doing all they can to create an inflationary environment, and that's not to my detriment. And I'm getting an artificial bid, meaning the central bank isn't buying them, pushing values ever higher. I may as well liquidate that, and I may as well go short term. So I may as well join. The Fed, the Treasury wants to sell T-bills. Good. I'll buy 90-day T-bills. I'll buy 180-day T-bills. Why would I want to stay in the long end? If the central bank is buying it, give them all they want. That's my attitude about it. So if I was a foreign central bank, if I was the Chinese, I'd be dumping anything I had of a long-term duration. So I just don't know why anybody would, as an investment again, but be buying. And then again, and some people say, oh, you know what, the Treasuries are a sign of fear. Well, maybe, but I can do, for the extra, 30, 40 basis points, I can cut my duration. Look at what's the 10-year? 61 basis points. The 2-year is what? 26. So for 35 basis points, I'm going to take an extra 8-year duration? No, I don't think so. So I'd be moving down the curves to shorten my duration of exposure as short as possible. That's the way I'm looking at this, and it'll happen. It'll happen. I just don't know when. Because again, as somebody wrote a piece, maybe it was Yardini, talking about he had talked about the return of bond vigilantes, but they can't, because the central banks it's too difficult to get short treasuries. You can't make any money, because as you're telling Anthony, they'll push it right in your face when they come in, and nobody wants to go home short because you don't know what the plan's going to be over a weekend or overnight. So it's difficult to short the market, but they will have their day. I just don't know when.
Yeah, just hearing you talk, it sounds to me as though the play is over. The move is over. We're entering a time now where I think it's just going to be choppy.
Oh, choppy. All right. Sure. And you know what? As we like to say, trade the chop.
Yeah,
You're good enough, and you trade the chop. That's it. But trade it. Do not position it. Do not position it.
Yeah, it doesn't lean at this point more to one side than another. It seems to me as though you just watch the reactions on your resistance. If it reacts the way you want, you sell it. And if you get to support, you watch the reactions. You get the reactions you want, buy it. Because for me, even though I'm a day trader, I like to know these macro themes, because I tend to side with the macro theme a little bit more aggressively when it hits an area that's working with it. So for example, in treasuries, at the beginning of this year, I want to be more aggressive on the buy side, but now I look at it and go, yeah, nothing's changed in terms of wanting to be more aggressive on the long side, essentially because of everything we're seeing happening. But that move is probably, it could be done. I mean, maybe it keeps going, but as a day trader, like you said, it just feels like trade the chop. I think that's what we're looking at.
Yeah, I think that's right. And when the markets start to settle down somewhat, okay? My favorite point is to go back to February 2013. I did a show with Watchdog USA with Greg Hunter, and in that period, we had started to see that the metals had started to consolidate. Yeah, gold was consolidating between $1,550 and maybe $1,700, but it was consolidating. It was doing a lot of chop and grind in that area, and the S&Ps were, it looked like the Fed was getting a handle. The people got confidence that the Fed had stemmed the worst of the crisis. So the S&Ps had already had a rally off the course. Its ultimate bottom it was made in March of 2009, but there was interesting things going on. And I said on that show It was in February 2013. I said, well, gold has been interesting, but I would liquidate some gold here and move into the S&Ps because it's starting to show you through consolidated trading of the S&P that people are gaining a little more confidence that the central banks have won the war, especially with Europe, which had been under stress in 2012. Everything was starting to calm a little bit. People were willing to move more into equity. Well, I got beaten up badly by that crowd, but it was absolutely right. So we want to see, and that my point is, we want to see markets consolidate because those will make it healthier. These are not healthy markets. The dynamic movement, one headline, one tweet, one tweet about the amount of deaths, one less death, everything is really pandemonium. And then, of course, you get all the Fed action and you get the fiscal action. So these are all out there. We'd like to see some calm return.
Last topic for the day, Ira. You mentioned that you're trading commodities.
Yep. Oats
and wheat. In all the years I've known you and spoken to you, I don't know that I've ever heard you say I'm trading oat. No. Talk to us about what you're trading there.
I like to trade. Oats, as you used to say, there was an old saying at the Board of Trade grains, as the oats go, so go the grains. So that, I've always watched oats. It's a thinly traded market. But, and they have a lot of relationship to wheat because a lot of the oats, mostly oats grown, are up north because they have a short season. So North Dakota, South Dakota, Minnesota, Wisconsin, those are really the larger oat growing areas. So I like to watch it. And oats are, an animal feed as well as a human. So, they serve cross purposes. And when wheat goes up, less oats are planted because they're in so many of those same areas. So, wheat prices actually have held up probably the best of all of it as we sit here at 550, 560, because there's talk of, Russia not selling as much because they want to hoard, and ensure that they have enough stock for their people. So there's some of that going on. So I'm just watching them. The key, of course, has been those are just to watch, and I'll trade the oats. I have some interesting areas, believe it or not, but they're not. It's a very thinly traded market. The big players drive it all over the place. I trade very cautiously, but I think that there is a shortage. First of all, because there's so much more human consumption of oats. As we search for diet, and it's the type of food that people can now really stock up on. So I don't know. I'm watching it. I'm watching it really based on the wheat, which really has held up very well. The other commodity, sugar, is the demand shock from the virus, from COVID-19, has really been dynamic. Sugar's dropped quite a bit. Copper's dropped quite a bit. All the commodities across the board have dropped. And of course, nothing's dropped more than the energy markets. Of course, that was helped and fueled by Russia and Saudi Arabia with their quote unquote feud. I'm not sure that it wasn't designed, by the way, because the Saudis and Russians have actually been fairly close, because the Russians have done the Saudis some big numbers up in Syria and being able to calm certain events. So I'm not buying it that they're at each other's throats. I'm not. I've been writing about this, and I'm going to write about it more. That Putin, on Thursday, Friday, oil rallies because Trump says that, he called Putin, or he's got the Saudis. Putin is not making a deal with anybody unless he's getting something in return. So tell me what he's getting if he's cutting oil production. Tell me. Because a lot of the havoc, in fact, as much as the virus, on that one Sunday afternoon when it was announced that there was no OPEC deal, and we walked into oil prices collapsing, and I mean collapsing, that was a Sunday afternoon. That did more havoc to the S&Ps and everything else, to the markets, than anything. That was very dynamic because oil serves a very important purpose in the markets. And when we talk, we're going to bring this full circle, Anthony. I'm glad we're ending there. When oil prices are down, as everybody's come to realize, there's a lot less liquidity. And that's dollar-based liquidity in the global system because oil's priced in dollars. So when you get this dynamic drop, there's a lot of emerging countries who export a lot of oil who are really struggling, making the Fed's job tougher and tougher and tougher. So now you went from Donald Trump crying when oil prices were up at $60, going, oh, they got to get more oil, to now he's crying that they're too low. Because why? The impact on the United States with the jobs lost in the Permian and the Bakken, would go on, are going to be huge because we know these companies are going bankrupt. They were struggling when oil was in the $40 with the huge amount of debt that they're carrying. Again, everything comes down to debt loads and the prices, so they can't make it. You're going to lose very high-priced jobs. And these are, so it's going to really affect average hourly earnings going forward when you start to see all these high salary jobs leaving the market. But oil prices have now, attained a different one because, again, it reflects and is playing havoc on global liquidity. So it's a good place to end. Do I think they get a deal? Well, I only think they get a deal if the U.S. removes the sanctions on Russia, because I don't know what else Putin wants at this point. But he's not making a deal. Again, if you negotiate a deal, it's the give-get. What are you giving? What are you getting? And if Putin's going to cut oil production, he has to know that there's a get to him. And tell me what the get is.
Hey, everybody, I want to take a quick pause and talk about RJO Futures. They are a long-standing brokerage firm with personal broker relationships to learn, discuss, and trade the futures markets. To learn more about RJO Futures, please visit rjofutures.com. I was thinking the same thing and reading everything about this this weekend. I'm thinking to myself, what are they going to get? Right? Because just like you said, if you know the man, if you know the situation, he doesn't do anything unless he's getting something.
Exactly. And you know what? Interestingly, as Putin is Putin, when does he pull this move? When the world is focused on something else. He's always doing things when the world is focused. As I keep telling people, when did they invade South Georgia? It was in 2008 during the Beijing Olympics.
Yep.
When did he invade Crimea? During Sochi, the Winter Olympics in 2014. When the world's attention is elsewhere, the Russians are on the move. And when did he pull this? When the whole world's focus is on the virus.
Yep.
He is, and he's got issues. Everybody thinks, it's with Saudi Arabia. Yeah, it's nonsense. First of all, and you will know this because when we did that podcast back in 2016, October 2016, with Santelli, I had that discussion, I believe, with Shy Girl, because you asked the question, who's bullish oil, who's bearish oil? And everybody was bearish because they were all looking at supply. And my response was, I was bullish. And he said, well, why? I said, because for the first time in history, the Saudi Arabia king went to Moscow. The Saudi king does not go to Moscow. That was the discussion we had. Anybody can go look it up.
I remember that.
And oil prices did not go lower, even though everybody knew that there was all this oil. They went higher. They went from 45 to 65, I believe. So we had that discussion, and no. And the Saudi king was just in Russia again recently. Not MBS, but the old king. So this is far more complicated. Everybody wants to spin a narrative. The way I work is I want to see a narrative and go, no, that's not what the world points to, and I'm not buying it. Putin has something that he wants. Well, goddamn, give it to him. If this oil price is so important, stop dancing around. Those sanctions don't mean crap anyway. They've had no impact on them. And let me explain another part, and other people have covered it. So let's go back to oil being at $45 a barrel, okay? What did we close at, 28 or 28 and a half for West Texas on Friday. So, and it got down to 19 something, maybe 18. So in the last 2 weeks. So you look at the ruble, and in the beginning of the year, when it looked like commodity prices were going higher, oil was going higher, the dollar was going lower, the ruble was trading at 60, 61 to the dollar. We're now trading at 80 to the dollar. So when Russia sells oil and the ruble's at 80, well, they take their dollars, they convert it to rubles. The Russians, listen, they've sold off a lot of treasuries, by the way. They're not holding a lot of dollars. They've bought a lot of gold, the Russian central bank. So they're trying to move away from the dollar because of the sanctions. The dollars do them no good because they can't move them. In a way, the oligarchs can't move them because people are sanctioned and they don't have access to the SWIFT system to transfer all this money around the globe. So they're trying to get away from it. But if you start doing the math and you go, whoa, 80, let's see, we're at 80 rubles and we're at $28, so let's call it $30. So that's 2,400 rubles to a barrel of oil. Well, when the ruble was 60 to 1, 8, 9 weeks ago, 10 weeks ago, and oil was $50, let's say, that's 3,000 rubles to a barrel of oil. So right now, the Russians are not struggling as much as everybody else because the ruble has soaked up some of that. And if the Russians aren't undergoing a lot of inflation, and they're not, by the way, they actually have a very good central banker. I call her name is Elvira. I can't pronounce, I can, but she's the head of the Russian central bank. She's actually very good. I read stuff that she writes. And Russian inflation has been low, even as the ruble goes up and down. So they're not as in bad a shape as others think. But you better ask yourself, as a trader and as an investor, what does Putin want? And if Putin gets what he wants, again, one of my favorite trades is to buy the RSX fund, which now probably has a dividend of about 6.5%, 7%. And they're not carrying a lot of debt. And it's Russia, but the stock's been beaten up. It was at $25 back in maybe even 26 back in early January, mid-January, in February, I think. And it got down to 15. I think it's hovering back at 17. So it's actually one of those that I like to watch in reference to all of this. So a lot of interesting things out there, Anthony. And be a trader. Don't look for major investments here yet because there's still way too much uncertainty.
An absolutely incredible time to be a trader right now because of all the things that we talked about today, Ira. And thank you so much for sharing so much insight with us on your blog and on this show. Where can people find you on Twitter and the website to your blog, please?
Notes from Underground. And if you don't subscribe to it, you can subscribe to it. Ira Harris, YRAHARRIS.com. And that's my Twitter. I don't really tweet out much. The blog gets tweeted out, so you can find it there. And that's it. And I do all these podcasts, which, Anthony, thank you. I do the FRA podcast, and I'm out there quite a bit. And again, if you're really looking for the macro big picture and then trading it inside, I don't think there's a better source than what I offer up.
Hands down, the best source for me. I read every blog that you put out, and like I said, I just really can't thank you enough for your friendship and just leadership for traders over the years, helping us understand things that we couldn't figure out in books, Ira. I can tell you that. I mean, just from hearing you speak today and reading your blog posts over the last several years, I've learned so much, and thank you so much, my friend. I wish you nothing but health and the best for you and your family during this crazy time. Thank you again for coming on Futures Radio Show.
Yeah, and thanks for having me. And as I say, Anthony, you know this, I'm not just putting this up. I eat my cooking. You are getting from what I'm actually doing. I don't put the trades. I'll put the concept together for people, but as I always say, you got to go figure out your own risk tolerance and figure out where you're comfortable at. But if you think the picture is right, get on board and get on it.
That's right, my friend. Thank you again so much for joining me today.
Yeah, my pleasure, Anthony. Be well, and everybody stay healthy and adhere to the guidelines that they're putting out there for us, especially old people like myself. At 67, I'm in the vulnerable group. But I'm going to go take a run, because if I can still run the golf course every day, I know I'm healthy. That's my test.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.